My view is that you should be looking out for deals in any market, up markets, stable markets, static markets, down markets. There are always deals available.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to small deals that you can do even without significant capital. Today is a solo cast, and my last solo cast, if you haven't listened to it yet, you should check it out, is on doing deals in a recession and why there are opportunities, specifically to do deals in a recession, and even, discussed the possibility that, at some point there'll be another recession and whether you should be, preparing for that. This is the other side of the coin. This is doing deals. This solo cast, I'm going to talk about doing deals in the good times, in the up times, and what the benefit of that is, and also what some of the risks are as well. So let's talk about that, right? Right now, even though, there's always some noise, hey, that, this risk things in the economy in terms of whether it's the debt, whether it's some indicators around, jobs and things like that, whether it's trade war with China, et cetera. There are a lot of good indicators, right? I mean, consumer confidence has been decent. Unemployment is low. Stock market is high. There is significant availability of capital, which is something that happens in good markets that I want to talk about. So let's talk in general. And listen, you can make your own judgment in this day and age, in this moment, as to where we are in any given cycle and, which way you want to bet, although timing a market's always tough. So my view is that you should be looking out for deals in any market, up markets, stable markets, static markets, down markets. There are always deals available. So let's talk about the opportunity to do deals in good markets. Whether you believe this is one or not, you can apply this to another time if you think we're heading in a different direction. I think there's still some more runway here, but who knows? So what happens what are the advantages in up market? Well, first of all, there is availability of capital. And although we always say, and we've done a lot of examples on the show of deals where you don't need any capital, minimal capital or no capital up front, listen, availability of capital does provide the opportunity to do certain types of deals that you wouldn't otherwise be able to do that do need funding, whether that's M&A acquisitions, whether that's, certain strategic alliances, where there's a significant investment needed into hard assets or heavy marketing or things like that. And, there's a lot of money around right now. And in good markets, there tends to be a lot of money, and people were looking to deploy that money in ways that make sense. And the cost of capital, because there's a lot of money, the cost of capital is often lower. And the investment standards, whether that's lending, whether that's equity investments, et cetera, sometimes get relaxed. Now, from the point of view of an investor, that's a risk on their side, right? That they end up potentially overpaying for deals, or in the good times, the banks relax their lending capabilities, and we've seen that run into trouble. But from the side of the business owner, the entrepreneur, the executive who's looking to grow a company, having inexpensive money with fewer restrictions is potentially a good thing. Now, obviously, if you take money you can't afford, and you take it in a way where you make a bad business decision and do a bad deal, or using it in poor ways, you can get yourself into further trouble. But if you're using it to do good deals, well, that can be a great thing. So that's certainly an advantage. Another advantage is that if you identify companies the way you think you can run them better, or where there's some synergies or opportunities that are beyond what the current company is doing. So very often, this is true in any kind of market, right? One of the reasons why you're buying a company is because you see an opportunity in it beyond what the current owners are able to do or see or are willing to do or have the capacity, whether it's, because of capital, because of talent, because of, maybe they're at the end of their career and they just don't have the energy or desire anymore to move into the next direction that maybe they even know they need to go there, but you do. Or maybe you're buying a company that's strategic, that's synergistic to what you're doing, and you have the distribution of a similar product, and you have the ability to sell more of whatever it is that you're buying, right? Or you have better technical skills that can make the product even better, or combine it with some other product that makes it more valuable, right? Usually, there's some. I mean, listen. If I'm talking about in an M&A deal right now, if you're going to buy a company and the other side's going to value it based upon their historical financials, and you think you can't do anything more with it, well, that's not a great deal. I mean, it might be an okay deal because maybe the company throws off good cash flow, and you'll pay off the debt service, or you'll amortize the capital you put in over a period of time, and you'll add accretive revenue and profit to your bottom line, and it's a nice kind of deal. So I'm not saying you don't do those kind of deals, but the really successful deals, the ones that have big upside, are the ones where you can say, hey, the company's doing pretty well now, or maybe they're not doing well, but I know when I bring them in to my company, that because of our expertise, because of our particular talents, because of synergies, because of an opportunity we see that the prior owners don't see, or whatever it is, that there's a lot of upside. So what I'm going to pay for the company is going to be less than, not only am I going to get over time the accretive profit after I advertise or debt service, but there's an upside. I can take this company to another level. Well, in an up market, the ability to do that, if you see those opportunities, you can leverage that much more quickly, right? Because the market is good, and because whatever opportunity you see for that synergy, for that combination of product, for that improvement, for that additional sales channel, you've got a good economy to sell that into, to move that into, and it's going to accelerate much more quickly than in a down economy where maybe you got a little cheaper, but you're also going to have a longer runway to be able to get it to fruition, to build out that and execute on that plan. So there's that ability to run with a good economy in that gap opportunity that you see, for example, in an acquisition deal. And by the way, it's most easy to see there, but it's the same kind of thing. I mean, if you see something in a joint venture or a strategic alliance of some sort, because you see that there's a 1 + 1 = 3 or 5 or 10 opportunity there, well, in a good economy, you're able to probably leverage that more quickly and more at a higher level for a longer period of time than in a down economy. So that's a potential reason to do a deal in an up economy. So let's talk about some of the challenges, and then we'll also come back to some of the other benefits. Some of the challenges, on the other hand, is that companies can get expensive, especially if you're talking about on the M&A side. Or even on, let's say, a licensing deal or some other deal. If there are a lot of people out there competing for these types of deals, and there usually are more competitors in a good market because more people feel that they can do it. They're more confident. They're more flush with cash. There is more money out there, meaning not only to back entrepreneurs to buy stuff, but where venture capital firms and private equity firms are buying and sometimes driving the prices up. So you got to watch out for that. All right, you don't want to overpay in a good economy because if the market does turn and you've overpaid, you can have a problem. On the flip side, if you've done a good fundamental deal, this is the key thing. If you've done a good fundamental deal that really, really works and has the right kind of cushion and you haven't overpaid, even when you hit a recession, you are probably in a position where you can ride it out. And that brings us back to the positive side, where the scale that you've created by doing deals, whether that's in terms of the additional revenue or profit or size of the assets, the company, or size of the employees, that scale, although obviously it could be a liability if things really go down and you haven't cut quick enough, if you have to cut some expenses, it is also a benefit because companies with more scale, if they're fundamentally sound, if they're not leveraged, if they didn't get scale through highly leveraged, activity like taking on a lot of debt, are usually the ones that are in a better position to survive the downturn. So scaling now in the upturn actually puts you in a better position to get through the downturn. And by the way, then to do deals in the downturn, like I talked about on the last podcast, and then be in a stronger position coming out on the upturn because there are fewer competitors. So, one of the ways you potentially prepare to do deals and survive a downturn is actually by doing deals during the good times. The other thing, that is sometimes a challenge in good markets is that talent becomes scarce, and there are definitely industries. We could talk about the political wranglings around the unemployment rate and how true it is, or whether people are underemployed, and there's definitely a lot of truth in that. But what there clearly is true in a number. I mean, I have many entrepreneurial clients and friends, and talk to people in tech, boy. I have a couple of friends who do tech recruiting and and place people. And their bottleneck is the ability to find good talent. I mean, they have jobs that need people. So sometimes talent is a challenge. But hopefully you've built the kind of culture and you compensate people, at least competitively, and you treat them well, and you pursue them to grow, and you have the ability to maintain great people and attract great people even in a good market. And the truth is, listen, if even though you may have to pay a little more for the right people, that marginal additional amount is not going to kill you. What will kill you is if you're paying people just significantly above market. And frankly, the people who are only looking at and making top dollar are probably not the best employees anyway. And those are the first people who run you into trouble when the market does turn down. So, talent may be tight. That may be a little bit of a challenge. But at the same time, if you can secure that key talent, there is opportunity for them on the upside to grow. And if you create, this is where creating your compensation and what I call attraction and retention vehicles for key employees, whether that's through some sort of equity sharing plan or synthetic equity like a phantom equity or an equity appreciation rights or profit sharing. We do a lot of those for clients, and there are ways to make things attractive, especially in an up economy, because if you're sharing profit with people or sharing some portion of the value of the increased value of the company, whether that's through real equity or synthetic equity, then that growth opportunity that you have in a good market makes those kind of vehicles attractive. If you give somebody a profit sharing incentive or a equity or equity equivalent incentive, and you're in a down market, you're not making any profit, and the company's not going up in value, well, that is not, in the short term at least, any kind of real incentive. Now, you hope when those times comes, you have longer term thinking employees who will bank upon it coming back. But in the up market, you can show direct opportunity from those compensation and attraction and retention vehicles to keep employees in a way where it's tougher in a recession, and that allows you to be able to do more deals because you have the right talent, or you acquire the talent through deals and put the right comp plans in place. Sometimes what happens is one of the gaps is that the prior company, maybe it's an old-time owner, right, who has not modernized their compensation and attraction vehicles, or is the kind of person where it's their baby and they're not going to share equity, and you're able to reinvigorate the existing employees of the company and or attract and hire employees who wouldn't otherwise come, because you have that upside and that opportunity we talked about, and what you see you can take the company to, but also because you're able to modernize or update or have a more equitable and incentivizing compensation and an incentive plan that can bring key people in. And that's easy to do in an up market, right? So, that's another reason to do it. And like I said, deals is something you should always be looking to do up, down, or sideways market, because as long as you get clear on your objectives and you get clear on what's going to be accretive to the bottom line, and you get clear on what you think the upside is, then there are going to be good deals in every market. There are different things you have to watch out for. You have to watch out for the dropping knife in the recession times, and you got to watch out for the overpaying and the inflation evaluation in the up times. But in both those cases, there's opportunities for deals to be done. So I think this is a great time to look at doing deals. And listen, I'm doing a lot of deals for clients these days, and there's a lot of good deals being done. Things that are going to really, help them grow and then set them up for the future, and expand the types of services they're providing to their clients, and and leverage the opportunities of the combined expertise of the two companies and of the scale, or of the licensing deal they've done, or of what they can do with the funding that they've gotten. So that's what you want to do. You want to see what kind of opportunities there are out there, see what you can leverage. You can leverage and always look at what kind of deals are available. And listen, even in even in great markets, right? There are still always people who are looking to retire, or looking to move on, or want to move into the next business, or decide they don't love being owners or entrepreneurs. So there's always going to be times to take advantage of it. You just need a little more deal discipline and uptime so that you don't do a bad deal. But listen, and if you overpay in any market, whatever the market is, it's a bad deal, right? It's just that because of especially on bigger deals, because there's a lot more capital being deployed. Even though that's a good thing, it also can inflate deal prices, and you need to look out for that. It's less true on the smaller deal and the medium deal size, but that's something to be aware of. So listen, if you have any questions about deals at any point, obviously reach out to me. By the way, if there's any topics you want us to cover on this podcast, whether it's one of my solo casts or you have a suggestion for a guest or a topic you want to hear about, reach out to us. You can comment on social media. You can reach out and email me. The intention really is to have these podcasts be information of value. They're always free. It's going to be, and between the great guests and the topics that I cover, we're hoping that we expand your appetite and ability and curiosity to do more deals, whether we are in up markets, down markets, or wherever we are in the cycle. So, folks, it's always great to be with you, even though it's a one-way recording. But I always actually envision a bunch of you listening, and I hear from you that we just keep growing in listeners, and it's exciting to me, and I'm thrilled, and I'm hoping it's helping you grow your businesses. So, with that, I'd like to thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. Well, it's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.